This
the
conference
P&L.
will now be recorded.
So tonight's presentation is more of a workshop. So I am absolutely going to have an interactive presentation for you guys tonight. So I'm absolutely wanting you guys to talk through this with me, ask questions. This is a working presentation. So if you guys have questions, please feel free to ask throughout the presentation, and you can just caught it. Yeah, it was the clip. You can just ask away. Um, Again, this is a working presentation, so here we get my thing here fixed. Speaker, getting excited there. Um, so again, please ask questions. This is all about learning and understanding line items and budgeting and profit and losses. So shall we begin? So on the agenda, I want to give you just a couple of thoughts from a banker's point of view on our economy. There's a lot going on right now, as we all know. So I figured I'd give you thoughts from behind the curtain. Not that we have all the secrets or anything, but we are here. We do a lot of studies on a lot of different economic indicators. So I figured I'd share a little bit of that with you tonight. Banker's Bible. This is a pretty fundamental key indicator and kind of use that we use in the credit world when we are talking about extending credit to a business. And then, of course, creating a budget and understanding the profit and loss. You guys have handouts. We will be working through those handouts together as a team and figuring out the ins and outs of that particular document. So more to come on those. And then I'll wrap it up with financial pitfalls, things that you that you'll want to avoid if you can in the business and business cycle. So let's talk economic environment for a second. This is a picture, it's a very colorful picture, isn't it, of yield curve inversions and recessions. So let me explain this graph because it looks very mountainous and valleys. And so what we have here is this line, this horizontal line is 0%, okay? So this is where the plus and the minus equals out. This yellow line here is when it's the 10-year yield minus the 2-year yield. So does that make sense to everybody? So longer term rates are 10-year, shorter term are 2, subtract the 2, and usually in normal times we end up with a positive number, right? A positive percentage. Well, occasionally throughout history, the 2-year minus the 10, or the 10-year minus the 2-year has gone negative. So what that means is that short-term rates are now more expensive than long-term rates. Doesn't really make sense, right? Why would long-term rates be more expensive than short-term rates? Good question. It's just when that yield curve goes inverted. The vertical highlighted, the light gray, that is an indication of a recession. So throughout history, pretty much every time we've had an inverted yield curve scenario, we've entered into a recession. We just came out of an inverted yield curve scenario about 5 days ago. So, what's that mean? Recession's coming, okay? Do we like recessions? Well, actually, recessions aren't actually all that bad. You can see here in 2020, we actually had an inverted yield curve no less than 2 years ago. So to say a recession is bad, a lot of times a recession is actually just, oops, I think I might have. A recession isn't necessarily a bad thing. It's just a reset. So again, 2020, if you guys recall, right around March, we had what we would call a recession. Well, what happened after March? COVID happened, but the economy went crazy, right? I mean, it went berserko. So I guess, what does it mean? To your point, this is my, we take legal advice from Chicken Little often. So what does it mean? Who else? Yes, all of the above. My advice, my official advice, is don't take advice from a talking chicken. Don't do it. So basically, to sum up economy, recession isn't necessarily a bad thing, and a lot of times we don't even know that we're in it until we're out of it. So we have a lot of doom and gloom that goes on today in today's news, especially. And that just means that we really have to watch internally and we watch our businesses and what we do day to day. And many times, your business doesn't know it's in a recession. It may never know it might be in a recession or it's in a recession. You might be one of the lucky few that actually comes out smelling like a rose and has better revenues than you ever did before. So there's lots of conflicts there. I guess the overall advice is watch your bottom line. Don't watch the news to depend on how you're going to wake up the next day. Questions on that? The Banker's Bible. This is something we use internally in qualifying a business for a loan. So I'll begin with character. Character is probably one of the most important aspects of decisioning a loan, and we get to decide that. So character is the type of person and the type of business that you are. So when you come to me and you say, I want a line of credit, we get to have a conversation. And if you're a true and honest and upfront person and we have a great conversation, I would deem that as you have good to great character. If you come in and you start lying to me right off the bat and your numbers don't match up and things like that, that's strike one, and it's usually a strikeout at that point. Does that make sense to everybody? We depend mostly on our judgment and our internal clock a lot on how we make decisions still to this day. Now it's supported by all the rest of this, but character is really the number one thing that we really count on, because at the end of the day, capacity, collateral, capital, conditions, if you've got really good character, you're really going to make it a point to pay us back. Capacity. What is capacity? Anybody know what capacity is? What we would call capacity? It's another term for cash flow. So to the capacity to take on the debt and to pay back the debt service. What about collateral? What's collateral, guys? Assets. What was it? What you have to back. Yep. Collateral is what we would consider something that is marketable enough that we would be willing to lend on it. So we'll just say you show up to my desk and you've got a Renoir, a painting, if you will, or a Van Gogh of sorts. That's collateral, right? Those are very valuable things, but we don't lend on that kind of stuff. That's more asset-based lending or collateral lending. And although we think it's a very pretty picture, we're not going to lend on that. So we need something that's readily marketable. That's why banks are so good at lending on cars and houses, and we're getting pretty good, and we're at businesses as well. Why? you ask, why are we so good at car lending? Why can we put a value on a car? You're onto it, yeah. Yes, you guys are actually all correct. The art is only what somebody's willing to pay for it. And there's only a very, very small market that's willing to pay that kind of money for it, right? A Van Gogh is only worth $1 million to the person who thinks it's worth $1 million and has the capacity to pay that $1 million. Whereas a used Nissan Sentra in 1985 is worth $3,000. We all know that because we all have the capacity and capability to actually take out a loan or to buy that vehicle, right? Capital is another one. That's something we look at a little bit more in the business world. Capital is a little bit like what we'll go over tonight. Capital is how you look overall. And that means that do you have a positive net worth? Do you have a negative net worth? Do you have liquidity? Are your assets all tied up in long-term holds? And then finally, conditions. We just talked about the economy just a little bit. Conditions are very important. I can tell you that 6 months ago, we had a lot different thought process on giving a loan out than we do today. Why? Because of our economic conditions, what we're doing. And then lastly, common sense. And this goes both to internal and external. You as a business owner, you as a consumer, does this purchase, what you're asking for, does it make sense in your whole entire situation? These are things that you really need to ask yourself. We do get quite a bit of requests that are a little outlandish. Like for instance, we got a request recently for a Lamborghini as a working vehicle. I had struggled trying to find the common sense there, right? I got to sit in it. That was fun. So anyway, make sure that the sixth sense is also something you take into consideration. And this is something that you can apply to everyday life. It doesn't have to do with business, although we as judgmental underwriters, that's what commercial underwriting is it's more judgmental than anything else. This is what we take into consideration an awful lot. Budgeting and the profit and loss. So how many of you do a personal budget every single month? 3, 4. No, I see some heads shaking. No. That's okay. Kind of. There are many forms of a budget, that's for sure. The budget. My wife hates this word. She hates it. Hates it. It's like a 4-letter word. When I say, okay, it's time for the budget. Let's make the budget, babe. She like, I have an appointment over there and gotta go. So a lot of people like it. I love it. I love the budget, but it's important. So who needs a budget? In business, what business needs a budget? Everyone, absolutely. And I go so far to extend, I mean, it's a wise idea to not only have a business budget, I think it's essential, but also personal budget. Why is it important? This is another easy one. Yep. So you know what you're spending on? It's a measurement. When do we make a budget? What was it? Before. That's great. Okay, you get an A. So in the business world, generating a budget is something that, especially for not-for-profits, because in many cases you have to publish that budget, and it has to occur at least once annually. So when you're doing a budget, and we will do this exercise, and we will actually review the exercise, you'll want to go through and you'll want to create specific line items, and we'll go through all this, but make sure that you get it as accurate as possible. So what do? Understand your lines. These are line items, right? Trends, seasonality. So at this point, what I'd like to do, no peeking, no peeking. I'd like to give you about 5 minutes. And the first 2 pages of that handout that I gave you, just review it on your own. Make notes, see what you see, and then we will review it. No cheating, first 2 pages only. It's your 2-minute warning. All right, everybody good? Good to move on? Yep. Everybody good? Okay, so real quick shout out to a company called Capterra. This is the format that you're seeing. This is actually a free online budgeting tool, so you can go to that website that I've provided down below and create your own budget analysis and at any time. So I also forwarded it to State 48, and so you can find that just about anywhere if you go looking for it. So let's dive in. What did you see with Ian's ping pong balls that stood out? Let's start with the very first page. This is a classic layout. It's in an Excel spreadsheet, but you've got your revenues up top, followed by your expenses, and then finally your profit down below. What do you guys see in here? Cost of goods are high. Why would you think that cost of goods are high? Just out of curiosity. Yeah. Well, you bring up a very valid point. Yeah. Good point. And actually, he's absolutely correct. Normal cost of goods for a business in retail, you really want to be upwards of 50% of revenue versus cost of goods sold. These are a little bit high, but I did that for a reason. Specifically, the industry has a lower cost of good return on it. Retail ping pong's kind of it's not a dying sport, if you will. It's a being modified, right? What else did you guys see? That's a great observation. So capital injection money is typically seen in the balance sheet, where you would see that offset, that asset and that liability. If it were a loan, then you'd see that liability go under the liability section, and then the capital injection gets put into cash or whatever it happened to be. If it is cash truly from the owner, then it goes on as a balance sheet item underneath stockholders' equity or a loan from the stockholders, which it would then go into liabilities. So very good observation. What else? That's just a line item. I mean that there was. I just picked that out of the sky. So they don't have a retail store in Arizona. How about that? I know our taxes are somewhere about 9.4% for sales tax, and probably and higher where I'm at in Flag. So that's just an arbitrary number. We'll just call it, I don't know, Nebraska. They're selling ping pong balls in Nebraska. What other observations? Let me ask you this. So why did I separate out ping pong balls, tables, paddles, nets, and other? In a traditional budget, I've seen this both ways. I've seen it go down to incredible detail, and I've seen it have one line item, and they are a retail store for whatever, a convenience store where there's 6,000 different SKUs. You can do your budget however you want. Obviously, this is a working document, and it's really for yourself and internally for the business. but I will tell you that understanding and knowing your different SKUs will really help you in the future manage your business very intricately. And I'll explain that in just a few minutes when we move over to the detail. What else?
I guess I'd be curious when, as you're saying that, why on the revenue side, it's broken down a little bit in the cost of goods. You don't really know what the cost per those SKUs really are.
Yeah, that's a great observation.
Yeah, because you want to be able to see which one's generating the most revenue and which more profitable, so you put your time and money into that.
You're absolutely correct, yes. This gets into also vendor issues, right? And I'll cover that here in a few minutes. You can separate out by cost of goods sold, specifically what the SKU is, like ping pong balls or tables, or vendor that you receive it from, where the balls come from, whether they come from, manufactured in Tucson or they're manufactured overseas. You can really dive down deep into this. Now, is it a good idea to dive down deep? Okay. I like that, yes. You're absolutely correct. You're getting ahead of me on my presentation. No, all of these are correct. But remember, there's a couple of things that you need to keep in mind about with the budget. Number one, most likely you're the only one that's going to see this. So you don't have to be pinpoint precise when you create your first budget. There's also an element of fixed costs in this. So when you do create a budget, I want to bring back the fact that you can call out how much you want to spend for marketing, and you can pretty much determine where you're going to rent and what that cost is going to be. But there's other aspects that may not be within your control. For instance, payroll used to be a fixed cost, but I'm considering it these days to be a variable cost because payroll is really, it's being removed from the business as far as control goes. It's politically driven, it's socially driven. So there's a lot of other aspects that are going into payroll these days. So we're starting to look at that a little bit differently than we have traditionally. Usually you could pretty much peg it. You're getting $10 an hour and that's what you get. And that's no longer the case these days. So we're looking at it a little bit different. Utilities, you can pretty much peg what utilities are. So with what we are doing here with this, as we're going down line item by line item by line item, it's called vertical analysis. So you guys are doing what a commercial lender does when we look at a budget. Why is this the way it is? We are going vertically instead of horizontally. Now, horizontal is when your business has a little bit of age under it, and you can look year over year over year over year and really get minute into tweaks that you want to make. What else did you guys find?
It must be renting up in Nebraska too.
You're absolutely right. Yes, the rent's probably sub-market. Phoenix Metro, I don't even. Is it? Okay. Yeah, I was a little bit off on that one, wasn't I?
Transportation's kind of low. It costs like $1,500.
Transportation is low. The key point I want you guys to take away from this is specifically with this layout is what I did was I just input a bunch of numbers on that face budget, the summary, the full year, and this actually transferred it over to doing every single month. Now you can see it just kind of laid it out. It basically took my number, divided by 12, and threw it in that month. But you can actually tweak this. So if you guys do get in and happen to use this, it's a good tool to use, and you can also play with it. It's very user friendly. So besides rent and marketing, marketing's low, and sales tax is really, really low. What else you guys find? I'm profitable the first year. I mean, I just started in month 1, right? Boom. I lost 1 month and then I'm profitable. It's unrealistic. I know. I get it. Any other observations before we move on? Mm-hmm.
And you did month by month for a projection, you try to do any kind of variation frequently for like seasonal trends, or that was the note that I wrote.
Yes, you absolutely do. We'll discuss that in the profit and loss, actually, because we're going to actually compare the profit and loss and then talk retro to the budget and observations on. We'll just say that this is my initial projection for the year that I didn't go through. And then I'm going to go through the year, and then we'll come back and actually review that.
Just one last thing on the expenses.
Sure.
Just like there's other revenue, there should be a buffer in there for other unexpected.
Unexpected expenses?
Yeah.
Yeah. I mean,
Sure.
there should be something in there for other.
Just like meals and entertainment, there's nothing.
Yep, you're absolutely right. So let's go to the P&L because that actually occurred. You guys are great. You're totally segueing me into my next points. This is fantastic. Does everybody know what a concentration risk is? Concentrations, they can work 2 ways. So, and we'll use ping pong balls for instance. I have a customer that buys all of my tables and all of my paddles and 95% of my ping pong balls. One customer. That's a concentration, right? If I lose that customer, what happens to my business? It folds. Ideally in business, if you have anything over 25%, you really want to start diversifying. So this happens a lot with, it happened a lot like with Walmart purchasing and the large retailers. We get, specifically, I had a business member that was a very large manufacturer of halogen lights, off-road lights, and AutoZone and Walmart accounted for roughly 70% of their sales, their overall sales. They sold all over the world. It's a local Arizona company. Goes by the name of KC Highlights. I don't know if you guys recognize that. Anyway, 65% of their business sales were with 2 customers. Now, you can argue that it was not necessarily a concentration because there was 2, right? Well, what happened was one of them decided that they wanted to pay them differently. So instead of a net 30, I'm going to do a net 360. Do you have a problem with that? Yeah, we have a problem. Too bad, we'll go somewhere else. So even though you might have just a couple that equal a concentration risk, that still accounts for a very large portion of business. So something you really, really, really want to watch for. Now, as the business owner, that's on the customer side. That's the people who are buying from you. But there's another way that you can get into a concentration risk issue. What is that? Suppliers, absolutely. Your vendors, where you get your stuff from. We are having all kinds of fulfillment issues today. I mean, I hear on the news every other day. There's nothing we can really do about it, but baby formula. I guess Arizona, we just eclipsed now 51% is what we don't have. So not that is really a solution, but really with concentrations, it can happen on both sides of it. So if you get your supplier that then decides they want to increase their prices by 30%, what are you stuck with? No alternative. We see a lot of concentration risks on the supplier side, actually, more than you'd think. Because you develop a relationship. That's what we do, right? We get into business, we develop relationships, and then move forward. And we have our favorites, and they become our onlys, right? And then something happens. So, word to the wise, it's always good to have a backup. We'll talk about inflation and competition here. Individual line item variations. So let's go into the P&L at this point. The P&L is your really big one. It's big because it's my favorite. So don't worry about the page number 3 essentially for right now. Let's go into the individuals. Now you guys can. Can what's that?
Richmond American. I've been in my house 90 days and I still don't have a full range hood.
Really?
And I put money down on that house last March.
Okay, that's a great example. I don't know the answer to, unfortunately, having the multiple vendors because in a lot of cases, we as a society have gotten so concentrated on streamlining costs, the next best, cheapest thing, and then you discard the second best. So in today, I don't know the answer to that, unfortunately, but it's something to be watchful for. And if you have the opportunity, always have a couple more vendors in your pocket. Okay, profit and loss time. So we're going to look at the month over month over month. I'm going to give you guys a couple of minutes. I'll give you what, five again. Was that good enough? Okay. I'll give you 5 minutes to analyze your numbers, come up with observations that you see, and then we will discuss them. All right, who'd like to share? What'd you guys see? Month line, yeah.
I feel like the marketing expense should be based off the percentage of revenue, not fixed amount.
That's a great observation.
There's definitely like a seasonal trend, perhaps, like for 3 months there. Right. Like, what did they do differently without the, so I think that like, the stuff on marketing?
With the natural demand, just a natural trend in customers and certain parts of the year.
Yeah, we see that often with seasonality. To you guys' point, yep. Overall sales and revenues increase due to demand, and oftentimes it's seasonal. What else?
I think it gross revenue at 25,000 month one.
I'm really good at selling ping pong balls.
Why are meals and gifts like not on the first report?
Because I didn't budget any.
They were the unexpected.
I didn't budget any in my original budget that I wanted to do for the year, but as an expense, when I actually went through the year, I incurred that expense.
I mean, actually, I'm looking at the marketing and it's allocated exactly the same over the year, even though maybe they could allocate it differently to support them during slower seasons.
Mhm. It's a great observation. As a matter of fact, yeah, that's that's a very true tone. In many cases, why in month 8, 9, 10, was the marketing budget the same when if we were actually dependent on seasonality, you don't need to market as much. It's the high season, you know. You need to market when you're in your off season.
Is it missing the capital injection? Is it not happening?
This is actually, so capital injection does not show up when you actually start doing your expenses. Yeah. So remember, I budgeted it, but I didn't actually include it in my profit and loss. That would be a balance sheet item, which we're not going to discuss tonight, but it's another financial statement.
Shouldn't the payroll change with the seasonality as well?
Yep, that's an excellent observation. So the opportunity cost could have been great there. Yeah, it was seasonal. Yeah, our revenues increased, but we didn't do anything about it, right? That's a great observation. What else do you guys see?
I'd really like to know what they're spending on office supplies.
And it's the same every month.
And remember, with office supplies, a lot like with marketing, you can be under some sort of contractual agreement as well. So yes, it might have shown up on the same, but for instance, like we'll just say with radio ads, you buy a package deal and you pay the same. So even though it looks very mundane and the same, it could be I just spread it out over the cost of the 12 months when it cost me $20,000 month one. Now, that's very rudimentary. That's not very strategic, right? So yeah, it's a great observation to really kind of look into and go, okay, how can I tweak this and change this? There's seasonality to this company. It's got ebbs and flows. How can I really capitalize that using marketing? Do I want to put more budget into marketing? Do I want more dollars into marketing? Do I want less? What else do you guys see? Because I'm in Nevada and I don't pay sales tax. Yeah, now I moved from Nebraska to Nevada. I actually meant to say Nevada in the first place. Nebraska came to mind for whatever reason. I'm from Flag, so we've had like 2 warm days up there this year, so I feel like I'm from Nebraska.
One thing I noticed is like the utilities increased with the increase in the revenue.
Mhm.
I don't know if there's some correlation or.
Possibly summer months or winter months.
Transportation went up a little bit with the seasonality, and I would think it would go up a little bit more as you're kind of shipping more product out.
So I'm glad you brought that up. That's something I want to talk about because even though these are small line items, transportation actually went up 250% on that sheet. So between the beginning of the year and the end of the year, that increase, and it was sustained. So even though it's a small number, you really have to watch those consistencies in your fixed costs or the numbers that you can expect to pay. We'll just say, I did 3 deliveries, it cost me $75. Well, I did the same 3 deliveries and now it cost me $190 because gas is $5 a gallon. So as I increase, what does that mean? Is that something that's not going to stop? Is that going to put me out of a business eventually because I can't control that cost? So even though that is one of the smallest line items, it actually did increase by 250% from 75 to 190. Good observation. Let's take a look at the summary. You guys did a really good job. Seasonality was a big one. Transportation costs, wage increase. These are all great. You guys are very observational. Thanks for participating. You got all the ones I was looking at. So congratulations, you guys are successful banking underwriters. All right, so now what? We've looked at the month-to-month P&L. We've made our observations. Now we can go to our full year, which is the overall comparison budget to actual. I only split this out in 2 different ways. So it says month, year to date, and full year. Disregard the year to date. I did not put any year to date in there. Typically that has to do when you've got more than 1 year under your belt and you can actually do some specific analysis around that. So with that, this just tells you or me that I was extremely off on my budget, wasn't I? For the full year. I thought I'd make $40,000 with the capital injection of 50. I actually made 122 because I can sell ping pong balls really, really well, right? So the moral of this page is it's just a budget, right? It's not going to cost you, it's not going to hurt. But what it should do is it should teach you now when you go through your profit and loss that you can actually pull from your budget and pull from actuals to create a very specific analyzed analysis moving forward of your budget. So you can get really finite in that budget. And you can actually project year 1, 2, 3, 4, 5, 10 down the road after you get this analysis and these numbers and start really applying them. You can also tweak your business. We talked about marketing very specifically. Just a ping pong example, for the last 5 years, we've watched green ping pong ball sales drop. White ping pong sales have increased. Why is that? Do we have an aging population? Ping pong was developed in 1900, actually. Is the business agile enough to redevelop itself? What if I decided I wanted to now sell pickleball? Pickleball was actually established in 1965. Is it something that's going to take the place of ping pong? These are all questions we don't know the answers to, but again, you can actually watch this actually play out in your budget and your analysis, especially if you have those individual SKUs. I talked about the green ping pong ball. If that's listed on your revenue source and you see sales go like this, you can actually react to it rather than go, wow, my overall revenue is down. Why? I don't know, because I only have one line item. Exactly. What other questions or thoughts do you guys have?
I used to look at these with some less rec centers. We would have the month to date, your budget in the previous year, so you could see any differences.
Mm-hmm.
You don't know how many of the managers would just be like, oh, to use last month. No, I want your thoughts on why things changed. I highlighted things for a reason.
Absolutely. It's very important, you know, you bring up a very good example. Why not just use the last month's budget? Well, I don't know. We'll just take inflation, for example. You know, we thought at the beginning of the year, every economist that you talk to is like, well, inflation is going to be about 2%. Well, they make budgets on budgets on budgets on economy scales. Well, now they just had to go throw all of that out and redo it, and they're coming up with new information all the time. Well, inflation's at 8.7 now. That's more than 4 times what they had assumed. Well, inflation is just what materials cost. So every single business is feeling that. You know, cost of goods sold is going up by 8% versus what we thought was going to be 2%. So every single business is affected by it. Good thought. What other observations do you guys have? Questions? Ask me anything.
What's this one called again? What's this sheet called? The report?
That's your budget versus actual. So that's where you look inward and go, okay, how can I modify my budget now that I've got a year under my belt, or if your business is several years old, how can you take actuals and what you want to do and marry the two? Because a budget is truly, what do you want? You know, here's what I can expect, but here's what I want. And then kind of meld the two. Projections, another term for it. I will tell you, if you show up to a bank for a loan and you've got projections and budgets and you can prove based on previous numbers that your numbers are accurate and then you have something to back it, we're going to be real interested in lending to you just because you've done your homework. You're interested in your business, just like we are.
Can I ask a question like with businesses, like if there's no precedence, how do you gauge it a little bit?
By no precedence, meaning I have no history to base it off of?
No, meaning
Or
there's nothing like it.
yeah, so yes, there's no history. Well, what I would consider history, it's I have the ability to, and I have systems that compare peers of businesses. So I can look at a retailer and go, okay, I actually have comparisons on all the numbers for all ping pong retailers forever. New ones are, we go back to those 5 C's and we really rely on that. Like, okay, what's this person like? And do we, you know, how have they run their business? Has it been successful? And do we think it's going to be successful moving forward? Kmart is a very good example of that. It came out, it was a fantastic retailer, it was ruling the world, and then what happened? I mean, there was lots of loans to Kmart, and Kmart did what they want. Came in Walmart, competition, wiped them out. Real quick, I want to just make a quick note because I am a banker. Good debt versus bad debt. So what's good debt? does everybody, borrowing base? A borrowing base is simply it's a revolving line of credit that is monitored. It means that the bank pays attention to it and it is secured by accounts receivables or inventory. And it's an active line, meaning I come out to your business and I count your inventory and I go into your system and I look at your accounts receivable and I make sure that your assets, your current assets cover that. So simply put, that's what a borrowing base line of credit is. I think you all would agree that's good debt. You're borrowing at a 5% rate, a line of credit, in order to expand your 40% margin on your business, right? That's how we fund capital. Bad debt. This is a really cheesy example. Using a 29% interest rate credit card to buy equipment. Long-term asset, right? We don't like 29%. Nobody likes 29%. Now, very specifically in this, when does this become bad debt? Because it does. Yes, that is true, but it's a monitored line, so I actually, as the bank, won't let you advance. I will not let you do that. Yep. Time is when this becomes bad debt, right? It costs you 5%, but it's going to continue to cost you 5%. So when you're actually borrowing at 5%, and we'll just say you buy more inventory. If that inventory you bought at 5% sits, we'll just say longer than a year, 365 days, that is starting to hedge over into, this is maybe not something you wanted to actually use 5% money for, right? Because it just eats away at your margin. This is what most economists and bankers are doing when All right, what happens in a raising rate environment and what obstacles do business face in a raising rate environment? This is not a trick question. This is an easy one. The answer is purchasing power. It's now costing your business more to buy raw materials in this raising rate environment. Whether you borrow the money or inflationary, if the cost of goods sold is going up, because it is. It's costing 8% more to do business. Now, this is a relative question. I mean, what do? You can pass that forward to your customers. We've seen that. I mean, to go get a hamburger these days costs an arm and a leg what steak used to. That's passing the cost on to the customer. But in some, yeah, in a lot of cases, you can't help it. But in some cases, you can look internally at your profit and loss and what you're looking and see if you can cut things out or streamline things, going back to your budget and your profit and loss and saying, okay, I'm not going to pass the cost on to my customer. How can I absorb that cost for them? 100% discretionary on the business. Two things that we actually look at that you can probably look at as a business is sensitivity tests and stress tests. So at some point, this profit and loss goes to zero, whether it's a reduction in revenues or an increase in costs, right? Where is that sensitized? To put it a little bit differently, so if my revenues decrease enough to where I start losing money, that's that sensitized. When that net profit goes to zero, we got a problem, right? Unfortunately, that particular number can go into the negative, and then you've really got a problem. So what you can do is you can test it. You can say, okay, I can sustain a loss of revenue of 18% of my top line and still be profitable to my bottom line. So that's my tolerance. Stress test is actually an interest rate test, so you can increase in a scenario, you can go, what if my line of credit went to 18%? Can I still do business? Because face it, folks, the Fed right now they're pretty happy with raising rates, and they're going to continue to do so. So, I mean, what is that to where it's like, okay, I can no longer use borrowed money, which is what the Fed wants. That's the whole reason they raise interest rates, is to stop lending, stop borrowing, purchase less. In my view, stall the economy, but that's just my view. So you can actually apply these to your business. So, questions on that? How about overall questions?
You said you guys really kind of changed 6 months ago. We're looking at lending. I'd love to hear your perspective on that. Was that just the talk of the Fed and knowing the raising rate environment was coming, and then what you guys are looking at ahead for the next year or 18 months? As your chart showed, we may see a recession, right?
There's two schools of thought. Overall, bankers are kind of doomsdayish. I mean, we kind of look at the glass half full, when we're looking at loans. So you have to kind of marry that. We knew this was coming. We hoped it would come. Just, the economy growing at what it was growing, at some point it's got to take a step back for it to then reset and continue on. You can't just go inevitably up and to the right. You've got to have resets in order to have that. So we knew it was coming. We were hoping for it. It's here. We take a little bit more caution now. Again, sensitizing and stress testing. Specifically, the stress test, when we're looking at doing a loan for a business, we used to use 3%. Now we're using a 5% stress test and a 7% stress test. So it's all strengthened in the actual balance sheet and the profit and loss and the tax returns. Do we think, a recession is 2 consecutive quarters of negative GDP. Well, that's not that long. I mean, really, truly. So you can get a reset, and most of us don't even know it. So from our perspective, we have to continue to be able to lend prudently, but we're not going to shut it off. I actually worked for an institution back in 2008 or 9 where we shut it off. I mean, it was like, put the skids on. You're no longer a lender. You're an asset manager, which is a workout officer. And that's it's not helpful at all. It doesn't help anybody. It doesn't help the economy. So.
Is there, Phoenix here, obviously, it's been a lot of development, a lot of jobs out there. It's in as good a shape, I would think, as maybe any other metro city. Does that play into your guys' outlook and decision on this stuff?
Yeah. Our last Great Depression that we had, there was a lot of frivolous lending activities that were going on. You remember the whole subprime deal, and if you had a signature and a heartbeat, we'd give you a house type of thing with a big fat loan. That has changed a lot. Our fundamental lending practices are very sound, so our practices haven't changed. Now, Phoenix as a whole is as healthy as I've ever seen. In that particular, the last 2008, 2009, we were heavy economically speaking in construction. It was one of our biggest drivers in Arizona, a concentration risk, right? As a state. And they really took that to heart. And I mean, we got so many tech companies coming in. It is so impressive. And it's so diverse now. Arizona, it's probably a stronger state than most of the states are, because they really go, okay, when the construction folded up and packed up and left, we had nothing left. We were all sitting around going, so now what? I mean, so they really understood and learned from that. And now we are projecting strong economic growth in Phoenix specifically for years to come, because Intel in the southern part of the valley, the chip factory, yeah, in the north, and those are the two biggest, and we're talking hundreds and hundreds, hundreds more that haven't even opened their doors yet, and these are all jobs that are going to be here. So.
Well, Ben also marries the construction into it. Sorry,
Mhm.
my husband's a construction plumber,
Mhm.
so when everything kind of went through me, he had to find something else.
Sure. Trades are a whole different conversation. I think that the real high-paying jobs will end up in the trades. That's just my opinion. But plumbers, you have to have an apprenticeship. HVAC, you have to be certified. These are hard working jobs that nobody wants. So what happens when demand is high and supply is low? Everything goes up, right? So I do foresee, and again, this is just back shop talk, but the trades are going to be very highly sought after and well paid.
They already had to turn away people from the maintenance part of it, where they could have them start their apprenticeship.
Really? Great question.
Sorry. I have a question as it relates to this budget, and how would you, if at all, adjust this if it was less of it was more like a service-based thing, business,
Mhm.
and I mean, like my particular example is like I do 1099. So like, how would you suggest maybe, I don't know, taxes, or especially if you're just starting out? I mean, I definitely didn't reject taxes. I thankfully have systems in place and people helping me, but I'd be curious how you would recommend adjusting that for somebody.
Service you don't get taxed on as far as sales tax goes, but just general over line items, especially like your SKUs. If you do one service, how can you break that out? It's a good thing to ponder too, because it's like, okay, you do one thing, how can you make that 3 that you can bill for? So then you can start expanding not only your services, but the things that, you're no longer just a singular point of revenue generation. Secondly, it is very difficult when you're in your first year to just project what you think you're going to, but there's nothing wrong with just putting it down, because you're just trying to brainstorm and collect everything that you can budget wise, and put it down. And then year 2, tweak it, based on your experience. And then year 3, years 1 and 2 to make 3, and then use that, where do I want to be? And conversely, what do I want to reduce this expense that's sitting here that I don't like very much because I think it's high? How am I going to reduce that? Good question. What else, guys?
I have a random question.
Ask a random question.
Does OneAZ Credit Union have business credit cards that can one apply for one?
Mm-hmm.
State 48.
Yeah, they got a State 48 credit card, actually.
Okay, and then all the requirements, I'm assuming, are on the website. You have to have an account with OneAZ then?
Not necessarily for a credit card. You do not have to have an account. I mean, of course, I recommend you have an account, but you do not have to have one for a credit card, no.
Is it difficult to get a business credit card? Because I heard you have to do the lines, right? With the blue line and blue net 30 and net 60, and build that up, and then you apply for credit cards, or can you just go forward and be
You could just go forward. There's a lot of different qualifications out there. Business credit cards are kind of the wild, wild west. truly. There's so many different parameters depending on what institution you choose. So there's not a set of policies having to do with business credit cards. Again, it's very judgmental. Other questions?
I have one more question.
Okay.
I'm curious, what would you, like, what is the difference in terms of loans between like a credit union versus a regular bank?
Very specifically, credit unions are very people centric. So you're going to get somebody like me that sits with you and plans with you and goes and wants the business to succeed and will be here through thick and thin, versus a bank where you're just a transaction. We're very agile when it comes to structuring as well. We can pretty much do just about anything. If I can dream it up, we can do it. So it's very nice because you will have a person to call and to bounce things off of. So we are not for, I mean, credit union overall, it's not for profit. You know, all the profits go back into the community. There's a lot of other differences structurally that way that make a credit union better.
I'm with Navy Federal. Yeah. So within 6 months, they gave me a very high credit card. Yeah. I feel like some farmers just like, kind of make it work, type thing, but.
Sure.
Good point, I'm glad you asked, because it makes a lot of sense, like, credit unions are more community relationship.
And we're fundamentally built by it. I mean, we are our community, so that's not going to change. So we're never going to be answering to the stockholder because the member is the stockholder. So what other questions you guys got? Food is here. So thank you guys for your time. I appreciate it. If you guys have other questions, I'll be around. So eating pizza, I think, right? Pizza. So thank you.
you make sure this was the right one, the short slide, or no?
I didn't go through it. Let's make sure. I can tell pretty quick. Yeah, we're good. Oh no. Yeah. Yeah. Excuse me. Sorry. Whoops.
No, exactly. That's for the Q&A section. Oh, yes.
That's all right. It looks the same.
Sorry, Brent.
That's okay.
Also, do we have the volume off in here? I turned it off. I feel like I can hear it. Maybe just where it is. Oh my goodness.
Is it too close?
Oh, no, you're fine. We were just for the virtual portion, so we didn't want any volume.
Oh, I see.
Yeah.
I see. I got you.
Sorry. Aha, got it.
There you go.
Go. There. Ta-da. And now you have this. This is on.
Perfect. All right. There we got it. All right, let's get going. So, hello, everybody. I'm Lou Farina. I'm from the SBDC. Anybody know who the SBDC is? All right, we got a couple. I'm gonna let you know who they are. Today, we're going to talk about alternatives for financing your early stage business. And so I'm going to talk more from like an equity perspective, a little bit on lending. But what I thought I'd do is I've got a deck here, and it's about 20 slides or so. I'm going to go through it pretty quickly. I'm going to do one slide on kind of each element, give you a lot of information. And then what I thought we'd do at that point, when I'm done, we'll do some Q&A, and then try to find out where you're interested, which areas you're more interested in. And then I've got some additional slides that we can go into more detail about those specific areas, and then really talk about maybe the pros and the cons of each of them. So that's kind of my plan. On time, we try to end about 8:30 or so. Is that kind of what our target? Yeah. Okay. All right. I tend to talk fast. I'll try to slow it down for you a little bit. So this is me a couple of years ago, maybe. So I'm a technology analyst for the SBDC here in Maricopa. My background is in corporate commercial ventures, working for Fortune 50 companies around the world, mostly investing in other companies, acquiring other companies. Let's see, what else you need to know about me? I've been an advisor, consultant. I was an angel investor here in town. When I left corporate America, I started as an angel investor with Arizona Tech Investors, so spent a fair amount of time with them. And I am a reviewer for the National Science Foundation for SBIRs. Anybody knows what an SBIR is? No, I'm going to tell you. Well, I'm going to tell you a little bit more about that. So, anyway, that's me. I'm going to give you the SBDC commercial. So, I'm going to give you the 2 minutes on the SBDC. This is good because we're a community resource and we're no fee. We're no fee because we're prepaid by tax dollars, partially funded as a program by the Small Business Association at the federal level. And then there's a state match with the community college district. So technically, I'm an employee of the community college district. And this is a national program. So in every state that you go to, there's an SBDC organization. They typically break them down by different locales or regions. And so I'm in the Maricopa Center. We cover Maricopa, but there's one up in Flag. There's folks up in Show Low, Prescott, Yuma, throughout the state. So what do we do? There's some areas that we focus on. And the first one here, this dovetails into Ian's presentation a little bit, lenderness, readiness, preparation. So if you want to go see a banker, and you want a loan, SBA loan, commercial loan, anything, we could help you get prepared. We could help you be that person that walks in to see Ian and says, boy, they did their homework, right? We help you do your homework. And so that's part of our services. We do again, SBA and commercial loans. I don't do a lot of them. I'm more the technology equity guy, and we'll talk about that a little bit. But again, we can do financial reviews, resiliency analysis, those stress tests that he was talking about. We can do that stuff for you. And this is all pre-engagement with a lender, right? To try to get you prepared. We have some expertise in buying, selling businesses, manufacturing. I'm the technology commercialization guy. We have some export international trade specialists. So if you're exporting, got some folks who know how to do that. Government contracting through a special group called PTAC. And so if you actually want to pursue government contracts, you're an existing business, you've got a track record, and it's time for you to move on. We've got some specialists that know how to do that, how to help find that business for you and help coach you through it. And then this was disaster loan assistance has been on the top of the slide for the last 2 years. First time I put it on the bottom of the slide because I think we're kind of through that. All the idle loans have kind of expired. At least the money's run out. PPP is over. And we did a lot of that during the pandemic. We had never done anything like that before, but we had just, we were just kind of frontline for a lot of that stuff. So a lot of folks know us from disaster loan assistance, and we're getting back to our more traditional type of activities. So what do we really do? So it's this thing called counseling. We call it advising counseling. So I'm an advisor. So I work with individual clients on a one-on-one basis, and we form a relationship, and we work through your business, no matter where if you're just starting, if you're in the growth phase, if you're exiting, all the way through. So we can handle it. It's a long-term relationship. We typically, are good clients. I've had clients for 3 years. We've had clients in the center for 5, 10 years. You graduate out, SBA says by the time you hit $50 million a year in revenue and you have more than 500 employees, you're technically not a small business anymore, so we can't help you. We can help the majority of the folks here in town, that typically under that limit. So there's that counseling, there's training. We technically call it training. This is part of training. We do a lot of webinars. We do a lot of webinars for other people. We do a lot of workshops for other people, depending on what they need. And then there's resources, and the resources are tools. So we have business planning tools, financial analysis tools, market research tools, all no fee. And they're fee-based products. They're commercial products, but we have contracts where we can provide these resources and tools to our clients at no fee. And they're really, really, really useful, really helpful, depending on where you are. So if you're, if you're interested in these services, again, there's no fee and there's no obligation. You sign up, you meet with a counselor, you say, hey, this counselor can help me. We work forward. If not, come back. It's no big deal. Go to maricopa.sbdc.com, or you could just put in Maricopa SBDC, request counseling, put your business information in, and then someone will contact you. Again, I typically, if you have a technology-based business, it'll get routed to me, but I got 14 different counselors now, at least here in Maricopa, with different specialties, so it'll get routed. So anyway, that's the SBDC. Okay, so let me just ask you, anybody here has attempted to raise early stage capital? Besides a loan, besides going out for a loan. Anybody try to raise any equity here? No? Okay. All right. It's new? Okay, good. Yeah, you have? Okay, can you tell me? Grants. Okay. So that's not really equity, but that's okay, but we're going to talk about grants a little bit, okay? I'll give you my 2 cents on grants. All right. So, introduction. All right, this is what we're going to talk about today. If you're an early stage company, funding is really tricky. It's really competitive. There's lots of ways. There's people, there's resources available to you. You know, where you start, what your options are. It's a big question. We're going to talk today about self-funding. We're going to talk about grants a little bit about debt, just a little bit about debt, friends and family, crowdfunding platforms. Anybody here got Kickstarter and some of the other? Yeah, we'll talk about that a little bit. Accelerators, incubators, accelerators, how they play into funding different ventures, competitions. Right? There's pitch competitions out there with prize money. What's sure been you?
Well, I went to do it, and then they're like, no.
Okay. All right. Yeah, Shark Tank's tough. It's tough. But there are a lot of like other competitions here in town that are Shark Tank like, but maybe not as glitzy. But there's prize money. Instead of investment, typically there's prize money. We'll talk about that. SBIRs, STIRs. If you had any techies in the room, anybody doing technical businesses, these are specialized grants. We'll talk about those. But they're really good for really risky technology businesses. Talk about angel investors. Anybody ever hear of an angel investor? Yeah, okay. So we'll talk a little bit more about who they are, what they are. Strategic investors who are a little bit different than angel investors. A little bit about venture capital, and a little bit about corporate venture. So that's kind of a lot, right? We got a lot on the plate. One slide each. Going to give you a kind of an overview blast, and then we'll try to drill down into what you guys are interested in. So, fair enough? Okay, fair enough. All right. So there's a little bit of a progression. I laid all those different items out, and really, this is time goes this way, essentially. The different stages, and these stages are kind of arbitrary. Idea, pre-seed, seed, startup, early expansion later. You can call them whatever you want, but the earliest is really your idea phase. And who typically is the first one to invest in your business? It's yourself. Always. I mean, we're looking at this from an equity investor's perspective, and we joke because who's the second, entity to invest? It's yourself, right? So you got to have some skin in the game, right? It's not much different than maybe how a loan officer would look at it, but you got to have some skin in the game, and that's all relative. We'll talk more about that. But then, then there's what's next. Okay, so then typically friends and family, crowdfunding, accelerators, competitions, grants, SBIRs. That's kind of the early stuff. And if you can kind of get some traction there with some funding, and you can get your business rolling, then you could start to maybe talk to an angel investor. Then they get to be interested, or a strategic investor per se. And after an angel investor, typically it leads to maybe corporate ventures or venture capital. I'll tell you about who they are and what they are a little bit more. But typically a venture capital, a lot of folks say, I need equity, I need an investment, I'm going to go talk to a venture capital firm. Well, typically it doesn't work like that, right? I mean, typically, unless you've been endorsed by angel investors, you've got some previous investment from others, and you really need a lot of money actually from venture capital. They're not really going to talk to you. It's really going to be very hard to get an audience. And then there's, most of us will never see IPOs or private equity. That's kind of the big stuff, right? Way down the line. So there is kind of a progression. This doesn't hold 100%. Like for instance, SBIRs, you can get anywhere down here, and you can go to competitions, but it is typically how it rolls. So, okay, so one slide on self-funding, right? Self-financing demonstrates commitment from you to your business. It should be used carefully, and a sustainable business shouldn't require ongoing self-funding. So you self-fund it, you get it going, then you can start to use other financing vehicles. You shouldn't have to continue to self-fund the business all the way through. You really shouldn't if you're able to really get some traction to build your business. And what you'll hear from investors is, again, you, the investor, are always the first money in. Unless you've put money into your business, most investors will not really consider an investment. You have to have it. And there's this concept of relative burden, right? So, some of us have different levels of means than others. You got to have enough in that it means a lot to who you are in your particular situation. Sorry? No. So yeah. Okay. So let's talk about startup debt. And okay, so lenders are risk averse. And okay, this doesn't look like Ian, I'll tell you that. But this is kind of my joke about lenders relative to equity investors, right? Lenders are really risk averse, and it's important that they are, because that's the function that they play. That's kind of what they do. They try to lower risk. It's challenging if you're a brand new company, and Ian, please feel free to comment, and you've got no track record, you've got no financials. It's really, really difficult for you to get a business loan. Right? I'm not gonna say it's impossible, but they're out there. It's really, really difficult. There are the loans that exist. They're commercial loans. There's a bunch of SBA loans. It's a 7A, short and long-term capital, 504 usually for buildings and new facilities, things of that nature. So startup debt is traditionally for new startups, promising startups that come to us, generally not an option if they're really early. Grants. Okay, so grants do exist at the federal, state, and local level. And we went through a lot of these grants during the pandemic, right? There was a lot of grants that were being let, and they were really being provided to help really save businesses, really, rather than start businesses. Right? We're kind of through that phase. There's still grants that are available, but most grants, if you really look at grants, a lot of them, it's a lot easier if you're a nonprofit, right? Because that's nonprofits typically on the receiving end. It takes a lot of time and effort for grants. You have to know how to write a grant. You have to be able to search for a grant. There's not a lot of free government money to start businesses. We at the SBDC, they come to us a lot, and we're free. Okay, that's nice, but really, there's not a lot of free government money to actually start your business. You can get some grants that can augment your business, can help jumpstart it, but you're really never going to build your business on grants themselves. They're nice to have, but that can't be your basic financial plan, is grants. CARES Act, again, existing businesses, and it's inadequate to fund your business. Okay, friends and family. Have anybody heard friends and family round? Go to friends and family round, right? Yeah. So it's kind of it's almost a form of crowdfunding, because you're funding from this set of people that friends and family are really, it's based on loyalty and affection for the founders. They'll put their trust in you to deliver business, no matter how vague it is. So you don't have to, you have to have real sophisticated instruments to talk to them. You could take small amounts of money from several family members or close friends to make to fill out your round. I'll give you, I had an example of a client who raised actually from friends and family about $170,000 for a really kind of very interesting startup. But he used a lot of his Navy buddies, a lot of his people who were close to him. I think he had 120 investors to fill out the $170,000. So it's small amounts of money, but lots of people. It's people who know and love you, really. Crowdfunding. So there's a couple different types of classes of crowdfunding. The first one is non-equity. So you're not giving any ownership away in your company. You've got Kickstarter, Indiegogo, even GoFundMe to a certain extent. So what you're doing there is you're giving, like, for donations, you're kind of giving rewards. You may give the product when you sell. Has anybody ever tried any of these crowdfunding campaigns? So it's kind of cool. I mean, if it's interesting, people will gravitate towards it and throw money your way. You got to have a good story. But there's the new class, and we call them Reg CFs, are equity. So now you can crowdfund for equity, and this is new. New last 2 or 3 years that the government's, the SEC's allowed this. And so fundable, crowdfunder, WeFunder, those are equity. And so what you're actually doing there is you're crowdfunding an investment. And for the investment, you're giving away a certain percentage of your company ownership. And that's very different than giving prizes or products, right? So these are available. They're getting to be fairly popular. Excuse me. Incubators and accelerators. So the difference typically between an incubator and accelerator, incubator is usually, you start your business and they're there to help you and help you get your business started. They provide resources, a collaborative group, maybe in a cohort. But typically an incubator, they accept you, and maybe there's a fee to you. You're actually paying them many times. An accelerator is kind of the other way around. It's like you've got very promising businesses, and they're designed for very selective businesses who maybe have their MVP and they're going to grow. But the accelerator provides mentorship, it provides expertise, but also can provide capital to your business. So they'll actually take a small investment in your business in exchange for the mentorship, maybe the space and the connections that they provide. So that's an option for folks. Competitions. Let's see. So anybody heard of Venture Madness here in town? Venture Madness. Venture Madness is a pitch competition, and there's not a lot of prize money. It's maybe maybe $10,000 for the winner, which is that's relatively small. But it's put on by the Invest Southwest and the ACA, but it's really good exposure. We get a lot of good out-of-state venture capital folks that might come, and angels. And it's kind of our flagship competition, and it was happening twice a year, and I think it went to once a year during the pandemic. I think we're going back to twice a year. We just had one in March. I think we're going to do another one in October. But you have to apply through it. You have to apply to it, and then you get some mentorship with that. And again, so it's really more about exposure, really good exposure. And even if you don't win, there's categories. There's maybe 5 or 6 different categories of 5 or 6 different companies that kind of compete with their pitches, but most of them get some kind of interest from the investors that are in the audience. The AIC Challenge, that's the Arizona Investor Challenge. It is from the AIC. It's $150,000. It's state money, actually. This is kind of interesting. So it's more for tech type of startups. But if you're pretty close to revenue and you're pretty promising, you can apply to the AIC. That's twice a year too. They give out, I think they gave out eight this last round, so $850,000. And these are grants. This is prize money grants. Some of the grant money is, some of the money is discretionary. Some of it's in-kind services. So you may get legal services and marketing services and other kind of services, but then you'll get some cash too. So it's a really good program. I don't know, Founders Live. I don't know if you've ever heard of them. It's a pitch competition They were here and they left. They're coming back. ASU Venture Devils. If you are affiliated with ASU in any fashion, whether you're a student, whether you're faculty or an alumni, you can go to their pitch competitions, and they run them twice a year. I've judged a couple of them. They again, there's prize money. I think last one I did in the fall, it was 15,000 for the top. I think we had 12 we were looking at. We picked 3 or 4. I think it was 15, 10, 5, and 5. I think that's kind of how the money was kind of given out. So there's money there's money there. And again, competitions, exposure. So if you're an entrepreneur and you've got a promising idea, you really want to get out and pitch. You really want to get in front of people. It's all good practice, and there's some benefits to it. And then MCC, Maricopa Community College, has, or Maricopa Community Colleges has a pitch competition called the Big Pitch, and they did that once a year. So anyway, lots of stuff with competitions. ASU Venture Devils, let's see. All right, we're going to skip that one because that one snuck its way in there. Okay, SBIR, STTRs. These are Small Business Innovation Research grants, highly competitive 3-phase award systems through 11 granting agencies through the government. You got the NSF, you got the DOD, you got the NIH, Department of Agriculture, NASA. And this is a way for them to seed technology, really risky technology that they want to see developed. These grants, they start what we call phase 1, which is your first is about $265,000. Your second phase, if you make it, is about $1 million, $1.5 million. And it's meant to jumpstart you. The DOD puts them out because they typically want to buy the product. So that's what phase 3 would be, a procurement. NSF, which is who I work with a lot, they expect you to commercialize the product after a certain amount of investment, after they put their phase 1, phase 2, their $2 million in, go get some private funding, commercialization, and go to market. So let's see, angels. Okay, angel investors. So typically they're high net worth individuals. Here, there's a lot of text here, and this is kind of the SEC kind of definition of an accredited investor. Usually an angel investor typically has to be accredited because of the regulatory exemption, Reg D. But an accredited investor is someone who's worth at least $1 million, not including their primary residence. There's an annual income, $200,000 to $300,000, depending. There are some amendments in there now that add a new category that you can qualify on based on personal certifications and just experience. So really, what the SEC is trying to do here with angel investors and accredited investors is, protect people from themselves, right? If you don't have the means, you don't really have, per the government, their boundaries. If you don't have the ability to tolerate that kind of risk, because this is really, really risky stuff. We could talk more about this if you want. Then they don't want you to invest in. They're kind of like, you're not accredited. You really can't get the Reg D exemption. So strategic investors. That's different than an angel investor. An angel investor also, I'll just add that they're looking for really high returns. So typically an angel investor is going to ask you, is going to screen their investments for about a 10 to 30x return in 5 years on their money. Okay, that's a lot, right? And there's a reason for that, because most fail, and you don't get a lot of money from most of your investments. You have to get that big home run, and that's what they screen for. Now, so not every investor, every private investor is an angel investor. If you have a restaurant or really a gym, you can pick up an investor, right? But they're not, I wouldn't consider them angel investors. They may be more strategic investors. They're investors that are interested in your business more longer term. They're willing to take a share of the profits. There may be some relationship between you. They could be a supplier. They could be a customer. They even could be a competitor to a certain extent. So they're kind of in your nexus of your business. But again, they're not as return demanding as an angel investor. Okay, so
Did you say most? Is it okay to ask questions?
say again.
Is it okay to ask questions?
But go ahead. Yeah.
Would you say most angel investors are investing in the tech world, those type of reasons?
Yeah, because of the returns, high risk, high return, typically. And that's how they kind of identify. So, but if you can come to them with a business plan that shows they're going to, get 10 or 30x and it's not in tech, yeah, I'm sure they'd look at it. But you can go to like angel and, there are individuals, and this again in the next presentation, if you guys are interested, there's individuals versus groups. And you can go to the group's websites, and you can go to Arizona Tech Investors, you can Google them, you can go to Desert Angels. They'll tell you what their appetite is typically, venture capital. So, okay, so they're actual employees of capital firms. They're actually funds, right? Where angel groups are individuals and they get together and invest together to form maybe an LLC to invest in your company. Venture capital actually has a fund. They're usually large institutions put small amount of their funds into high risk investments. That's typically where the venture capital folks will get their funds. They avoid early stage companies to a certain extent. They're looking for the growth companies. Venture capital typically you need to maybe justify at least $5 million to even really have them really interested. I mean, if you've been, it's really 5 up to maybe 50 to 100 to a certain extent. But if they know you and maybe you've got something in the seed stage, they may go down to 2 or 3 million. But it costs them. I mean, from a human capital perspective, it just costs them the same amount of effort to do a $5 million deal as it does the $50 million deal. So they would rather do more. So that's kind of the range for venture capital. They also will give you, whether you like it or not, you're going to give up control, a certain amount of control, and you're going to get an injection typically of help management to a certain extent. They'll help bring in their own folks once they make that investment. Not everybody, but strategically. Corporate ventures. Okay, so corporate ventures are corporate funds. They act a lot like venture funds, but they're out of a corporate arm, and they invest in startups. They invest in technologies that maybe they're internally developing or they see on their roadmap. There's some synergy between the two. These are really good opportunities for technology companies to a certain extent. And most corporate ventures will hang a shingle. So what I mean was like, if you can go to Intel Ventures, you can go to Qualcomm Ventures, you can Google them. Their venture arm basically says, here we are, we're a pot of money. This is kind of what if you're in the semiconductor industry and you've got some cool stuff in these areas, send us your stuff. We'll evaluate it. So there's some good things and bad things with regard to corporate ventures, but it can be a really good way to raise some capital, but it also could provide an exit for you at some point. So if they seed you and you grow and you do well, you may become an acquisition target for the corporate firm, and that's kind of where you get your returns, especially for the equity investors. Oh, okay. So business plans, right? We talked about just a little bit about business plans and how it fits. So that I gave you like kind of the overview of some of the investing vehicles, but I just want to talk to you a little bit about the importance of a business plan. So I don't know, Ian, I don't know if you guys require business plans per se, but I know many bankers will ask for business plans. Yeah. So, let me talk a little bit more about that. So, a business plan is really a blueprint for your business, right? If you're starting up a business, or you want to expand your business, like you wouldn't You wouldn't go build a house without, without drawings, without some kind of blueprint, right? It's the same thing for a business. So it's really important. Um, I like this slide. So this is my world. This is what I mean. How do I know? I mean, I sit down with entrepreneurs all the time, and how do I know what's in their head? How do I get it out, right? I mean, it's like, well, Lou, let's just go have a cup of coffee. I'm like, you don't know how much coffee we're going to have to drink for me to really figure out, what's in your head. And I've got it in my head. I got it in my head. You got to write it down. You got to write it down. It's just much more efficient. 3-to-1 rule, like if you write it, if it took 40 hours to write a business plan, which is not unheard of, it would take me about 120 hours probably of sitting with you to extract all of that information, honestly. So, and no one's going to do that, honestly. Really, very few investors are going to spend that much time. So, writing a business plan is a really good way to help communicate to others and to be succinct and be detailed. And there's something to be said about the written word, right? We can talk. I could take notes. We could talk, and I'm taking notes. But if you write it, is it efficient? Is it accurate? Can you write it? There's an element of credibility, right? Can you write a business plan? If I'm an investor, I'm thinking this person needs to be able to write a business plan if I'm going to give them my money. So important. So, okay, so let's see, how does this one work? Okay, so here I've got some target audience on the left. So banks, let's talk about banks, investors, partners, key hires, incubators, competitions, advisors. So those are all kind of important people that you may interact with when you're starting your business, right? So on the right, left to right, there's these different things that people require. There's this one-page executive overview. I don't know if you've seen them. Very important. There's a pitch deck they're going to ask you for. There's a business plan. What's your financial history? What's your financial forecast, right? Not unlike a bank. And then there may be an application depending on the entity, right? So if you're a bank, typically you're going to want a business plan. Typically, you're going to want financial history, right, Ian? You're going to want financial forecast, and you're going to probably need to fill out an application, right? If you're an investor, if you're talking to investors, they're going to want your executive overview because typically, if they can't digest it in a page, for them to get interested to have that next conversation would be very, very difficult. They're going to want a pitch deck at some point because that's the next level of engagement, and they're going to ask you to follow with a business plan. You don't have any financial history per se, but financial forecast is important. And if you're dealing with a group, you're going to have to fill out an application. Partner, let's say a strategic partner, somebody you want to do business with, somebody you want to work with. First, you probably a pitch deck. They're probably going to ask you for a pitch deck, some kind of overview deck about what you're doing. And they'll probably ask you for a business plan. How do I know I really want to work with you? Can you tell me about your business? Key hire, some key hires. If you're hiring at your C-suite, right, and you're a startup and maybe you got some funding and now you're ready to pay market for some good key hires, they're probably going to ask to see your business plan under non-disclosure, of course, because they're going to want to know what they're getting themselves into a lot of times. Incubators for the application, typically they're going to ask you for a business plan to go along with it. In competitions, of course, you're going to have your pitch deck. Typically, your business plan follows with an application. And if you're looking for mentors or advisors, they're going to probably ask you first for your pitch deck, and then they're going to ask you for your business plan. So I guess the point is, a lot of different partners, a lot of different elements to be able to provide to partners from an information perspective. But the business plan really is important. It really shows up in a lot of places. Let's see, okay. the other thing about a business plan, now, it doesn't have to be the 50-page business plan. I know anybody went to business school a while back. You know, they had us write these 50-page business plans. It took us 2 years to write, and by the time 2 years gone by, and it was just kind of outdated, right? That a 15-page business plan with some key elements. And I was going to send you guys some templates, and I forgot to do that. I've got templates. I mean, you can see the SBDC. We got all kinds of templates for business plans. That's kind of what you need. 15, 20 pages at the max, because no one's going to read 50 pages, and by the time you really write it, it's almost outdated. So it's a living document. So okay, so now I'll start with questions. Any particular questions? Any area that you want me to drill down on a little bit? I've got another deck I can work with. So yeah, no, yeah.
What would be your suggestion? I feel like a lot of people in this room sound like just getting started with a business.
Yeah.
On the advice of just going. I know you talk a lot about investing and that kind of thing, but just going grassroots. Obviously, it's going to depend a lot on your industry, right? But I was like, really, your advice on just going forward without looking for the outside money, really grassroots and groups. And I think a lot of people are like, oh, look, give up your business, but it's important.
No, that's a good point. So, right, bootstrapping, right? Like yeah. I mean, well, first off, investors love bootstrapping. So whether you go to investor or not, I mean, if you've proven that you can do a lot with a little, I'm really happy to give you my money because I know you will. But on the other hand, if you can, and especially in software, if you can self-fund and bootstrap, get your way through it, you may never have to ask for investment. You don't have, a lot of folks they think chasing the investment is really the end game. The end game is not chasing the investment, getting the investment. The end game is growing your business, right? And it can be done. It can be done. Now, there's a point where you get it started and you can bootstrap it, and you may need some expansion capital. But maybe you got to, maybe you got a year or 2 or 3 under your belt, and then you go see Ian, because I don't want to give away any of my business. I'm going to go get myself a business loan, right? I mean, why would I want to give equity up when I can take a business loan? Does that answer the question? Yeah, absolutely.
I'm just curious. I mean, I know we're talking mainly about startups, and that's where most of us are. But I'm just curious if at some point, and I guess this will vary.
Good.
Already kind of, but
Good.
do you recommend, like, if you're trying to scale and grow your business once you kind of have a few years under your belt and have a good understanding of, like, how you're operating, is there a particular track that you would recommend or something like that?
Yeah.
I mean, you're still trying to own your business,
right? Right. I mean, you don't want to give it away if you don't have to, right? So, I mean, when they come to us, when we see clients and they're trying to scale their business and they're in growth mode, the first thing we'll try to do is see are they bankable, because that's going to be your lowest risk. Is if you're getting a 6 or an 8% loan as opposed to giving 20% of your business away, that's preferable. But you may not be bankable at that point, and it may just be at the point where you're growing and you need this injection of capital, but the banks they're not really comfortable with that just yet. And we could help. We've got ex-bankers on staff, so we help our clients make those decisions. Then it becomes, okay, what do we do? Luke, should we crowdfund? Should we try to raise some some equity? So, yeah, but I definitely.
So even at the scaling level, I mean, you kind of recommend going with that chart that you showed at the beginning, where you kind of have your options. I mean, generally speaking.
Well, I think that chart that I showed you is really kind of the way the next person thinks about investing. So I don't think you really have much. I don't think you can accelerate that if you wanted to. Yeah.
But yeah, I guess just kind of like start here.
Right.
And then,
right. And move up.
Yeah.
Right. Exactly. Yeah.
Okay.
Yeah, that would be that chart, right?
Oh, yeah.
Yeah, typically. But here, I mean, this is like self-funding. That's the bootstrap. That's, I think 60% of software companies successful don't ever take any outside money. But if you're a SaaS business, I mean, software as a service, if you've heard of that term, it takes for the growth in that growth phase, it takes a lot of marketing money, a ton. It sucks up a lot of cash, and you're cash negative before you're profitable. It's a lot of folks. It's not there's no inventory per se, but it's that marketing upfront, that marketing push that gets you that subscribers.
What else do you look for outside of like the return and probably the operators, like when you invested into a business?
What
Like outside the norm of like people, of course, and the returns, like what would interest you in investing into it?
again, the people, return. Um, uh, is there an exit plan? Do you have an exit plan? I mean, that's kind of the first, like, I know you want my money, but tell me how I'm going to get it out, because, that's my goal. So if you've thought through your exit plan before, hey, these similar companies have been sold to these other companies, and here's the multiples they were sold at, right? Hey, this one went for 5x sales, this one went for 9x of sales. And so that gives, that's one of the things that you definitely look for. The other thing is, I guess related to return, but is financial projections, having some solid financial projections. It's really, really important. And then there's appetite too. It's, if you're an angel, you typically like to invest in things that you know and you like. So it's just like a bank portfolio, I would think. Your bank portfolios, they've got appetites for certain different types of businesses at certain times to fill out a portfolio, and investors are the same way. You got another one coming. That's all right. That's all right. That's all right.
You speak on the valuation process, because I know that
Oh yeah.
can be a million different ways.
Yeah.
So what's kind of like the standard? Because it's all. I mean, what are like? You hear so many different like ways
To value. Well, if you've got no, I mean, discounted cash flow is your best valuation method. But if you've got no financials, right? If you're pre-revenue or you're early in revenue, right? How do you do it, right? So it's fairly subjective. It's a lot like, in a sense, it's a lot like a real estate market. Like the same business in Phoenix will sell for more than the same business in Alabama, which will sell for about half of what it would in the Silicon Valley. So there is a regional element to it based on the investor community and how much money is chasing how many deals. But there are statistics. You can go to the Angel Capital Association, and they every year or so they actually give you statistics on pre-money valuations of. Let's see if I've got any of that in here.
Well, even just the established businesses too, right? There's so many factors of the industry and context of growth and all that.
There's a lot to it, yeah. I mean, but what's interesting, and it's hard on the founder, because the founder, it's like you buy a car, right? Maybe you buy a car, I don't know, if you're lucky 2, 3 times, 4 times in your life. Well, on the other side, the investors, I mean, they see they see hundreds of deals, and they're doing hundreds of deals. So they know that valuation. So there's asymmetry in the information, right? The investors know. The founders typically don't know unless they do some research to find out kind of what the valuation is. But there is definitely, let me see if I've got a slide. Angel. Oh, here's the appetite. You like that? Angel's appetite. let's see, I was gonna, and I don't have it here. You know, and so like last year, the average valuation of pre money, just the average was about $4 million. I mean pre revenue. I'm sorry, pre revenue. It's about 4 million. You know, it goes up to about 8 million. A lot down at about, if you're really early, maybe 1.5 million or so. Again, depending on the industry you're in, different factors. It also depends on what's in front of the investors at the time too. So, but go ahead.
For pitch competitions, can you kind of walk us through what these look like? And then as far as when they give the money out, is there kind of reporting requirements? I'm sure it can change a lot. But can you just like overview it?
Let's see what I have on pitch competitions, and I got some. Did I pass it? Yeah. Okay. Okay. Competitions. Okay. Um, uh, Venture Devils competition. All right. Well, we'll go here. So typically with the competitions, a lot of them are cash awards. Some of them um, will be in kind services. So you have to be careful. Not be careful, but you know it's a competition and you're getting a prize. You don't always get discretionary cash. Um, for the typical like a venture devils, I'll say for venture madness, like that kind of stuff, there's no real reporting requirements. However, if you're the Arizona Innovation Challenge, which is that local one, I said $150,000 from the state. Yeah, you guys are married for about, once you take that money, you're married almost for the rest of you got to keep your business in Arizona. There's all kinds of reporting requirements that you've got to fulfill. So, I've had, and hope nobody in this room from the ACA, but I've had clients walk away from that and say, it's nice, but I just I don't want the baggage that kind of comes along with the overhead of having to report. Some of them are in a nice position where they can turn down the money. So did I get all? Did you?
Yeah.
Did I get everything? Yeah. Oh, the other thing with pitch competitions, sometimes it's a reimbursement model, and what that means is you got to lay out the cash before they'll give it. They'll pay you, and a lot of startups aren't in. Then it's not cash rich. I mean, they're just not have enough cash to do that. It's a real strain, even if it's a $5,000 reward. They'll tell you what you can spend it on. Hey, you can spend it on legal, you can spend it on marketing, you can spend it on this, and spend it on that. Then you got to show receipts, and then you get paid. Whenever they feel like paying you. So.
So for a startup, say you have your family and friends are really poor. Your best bet is to do what, the competition?
Yeah. Yeah, to get some visibility, you can get some startup funds there. Yeah. It's raising capital is tough, and and unfortunately, some people are in a better advantaged situation than others. With regard to the environment and their connections and accessibility. I wish it wasn't that way, but it kind of is. It's hard. But I'll tell you. I know you got a question. Hang on. But I will tell you though, I work with entrepreneurs every day that figure out how to do so much with so little. You'd be surprised. And those are the ones that really, really shine. So you don't have to be cash flush per se. You just got to be really smart sometimes.
I was just gonna ask, like, in situations like that, I mean, would you ever recommend like diversifying kind of the different streams, like maybe it's asking your family and doing the crowdfunding thing and obviously self-funding as well, but just kind of layering the different
Yeah. Yeah, no, it's a good point. But the thing you have to think about is that it all takes time. So if there's a time thing, so if you're trying to run an angel campaign, a crowdfunding campaign, and you're running around with your friends and family, sometimes it's just overwhelming. So you have to just be smart about you can't really do it all at once, but you can do several. Yeah.
I think it's important not to like lose track of actual business that you're trying to get money for, rather than like, otherwise if you're not worried about your business.
Yeah, absolutely.
What's the money for?
So fundraising.
It all works itself out.
Fundraising is a second job. Primary job is the business, because a lot of folks get the lure of chasing the money and they forget about building the business. Yeah, you're absolutely right. Yeah. Yep. How am I doing on time? I'm ready. 8:32. So I'm willing to stick around. If there's any more questions, let me know. Hopefully I know a lot of folks are really early here and maybe aren't at the point where you're going to raise a lot of money, but hopefully this was educational, and at least you know about the SBDC. So if you need help, just generally getting your business started, I would definitely contact them.
So what's the difference between you guys and score mentors?
Okay, it's a good point. So score mentors are volunteers. Okay, typically a score mentor is somebody who has expertise in a certain area. They'll be an ex-finance executive, an ex-marketing executive, and they could be really good, really, really good if you find a good score mentor, especially in the area that you need some help in. The SBDC, we're paid, okay? So we hold our clients accountable. Like if you come to us and you say, hey, I want to start a business, we're going to say, okay, do this, do this, do this, come back in a month, let's talk. And so there's that factor where it's a little more rigorous. It can be a little more rigorous. And the other thing is we're typically more generalists. So we're a little bit broader in our scope. We can do a lot of different things for you. But I have clients that have score mentors that love their score mentors. And the other thing about, just personally, this whole entrepreneurship, find as many good mentors and advisors as you can. Come to the SBDC. If you like me, great. The first thing I'll tell you is go get 3 others. That should be your goal, is really to find as many good advisors and mentors as you can possibly find as you build your business. And score is really good. So.
Which brings me to a specific question.
What? Go ahead.
So like if I'm right on the SBDC website, right?
Yeah.
And then it says like set up or register for a consultation.
Yeah. Request counseling.
Yeah.
Hey.
Like if I have my bookkeeping system, right? Like because I have an e-commerce website, is there like a mentor that can say just review what I've done so far? Like if my bookkeeping's on point, can they offer that service?
Yeah.
Or would it be no, you gotta learn QuickBooks and...
No, they'll look at it. Yeah, you get an advisor and you'll put in there what you want.
Yeah.
And they'll try to match you up with somebody who maybe got an accounting background, whatnot. Then usually we start with our clients, we talk about their business, saying all right, what's your biggest problem? What do you want? Because we got to start somewhere, right? You can't do everything at once. And so if it's your accounting system, say, I need somebody to read my accounting system. Would you take a look at it? Say, yeah. And they may say, well, you really should get QuickBooks. So, that could be their answer, but I don't know. Yeah. Request counseling. Yeah. Am I done? Okay. All right. You're welcome. Thank you.